today's top three things in my notebook. Number one, the U.S. 10-year bond yield. Number two, the U.S. dollar. And number three, the price of gold. Just to hit on the 10-year bond yield quickly, last week, of course, you had a back-to-back surprise week on the economic data point front. Obviously, you had a 3.6% number on the GDP side, and then, of course, you had the second back-to-back monthly surprise on the U.S. employment front. And again, no matter how bearish people were on unemployment throughout the year, that's just too bad because obviously being bullish on employment was a good call to make. So what do you do with it? 10-year bond yield bangs the top end of its risk range and fails, ostensibly because there will be no taper in December, despite the economists, quote-unquote, in the Bloomberg survey doubling in terms of their expectations of a taper coming up here. So to be clear, we don't think that there will be a December taper, and the New York Times is leaking that again this morning. U.S. dollar, again, has been down for 4 consecutive weeks. That's why we think that, by the way. Again, we think the currency market leads, and we do think that the currency market is a lot smarter than a lot of other markets in this regard. And again, the dollar was down for 4 consecutive weeks, and again is down again this morning, and should be if there is, in fact, no taper coming. So again, look at it for what it is. The upside down of that is the euro. The euro is up 0.8% versus the dollar last week. And again, if there's another side to this trade, it's being bullish on euro, being bullish on European growth equities, which we call our Euro Bull Q4 global macro theme. Finally, gold. If I give you that rates down, obviously you'd probably be buying gold here. So again, rates rising is bad for gold, and rates falling is good for gold, and that's why we're long gold currently. No, it hasn't been working, but again, you want to be long a bunch of stuff. There's called asymmetry in your portfolio when you have stuff that works on certain days and stuff that doesn't work on other days. So again, if the dollar goes down and we start to see interest rates fall back to, call it 2.7% on the 10-year bond yield, we would think that gold acts very well on that. So those are your top three things.